Hi everyone, and welcome to part 2 of the International Rescue Committee's car buying video series, Budgeting for Car Purchase. In this section, we will answer questions such as, how much do you want to spend on buying a car in total, whether to use the money you have or take out a loan, how you find a lender and choose a loan, why the dealership wants to finance you, and how you can refinance your loan. So what is a budget? A budget is a tool that helps you decide how much you can afford to spend on different things by looking at your income and expenses and making decisions about your priorities. So what do you think is the first thing you need to think about when you are thinking of buying a car? It's your budget. It's a really good idea to think about your budget before you start looking for cars at all. It's easier to be realistic and honest about how much money you want to spend on a car before you start shopping. If you would like some support creating a budget, we would encourage you to contact your local IRC office to make an appointment with a financial coach. A financial coach can help you look at different options for working towards your financial goals and guidance as you purchase a car. Thinking about getting a new car is fun and exciting, but it also makes it really easy to get lured into spending more money than you actually want to. The cost of buying a new car is always going to be more than just the purchase price of the vehicle. And the purchase price is just the start. You also have to pay sales tax, dealership fees, registration, and other fees. When you find a car you are interested in, you will need to be sure to ask the salesperson what the dealer fees are. Salespeople will usually not tell you about these fees unless you ask. Each dealership will have their own dealer fees, so it's important to ask each dealership what their fees are. Dealer fees can always include what are called doc fees. Doc is short for document, which is all of the paperwork you do when you buy the car. Dealerships sometimes try to make extra money off of you by adding in other fees, so it is very important you actually read and understand everything on the documents you are signing when you purchase a vehicle. This graphic provides a visual of the true total cost of owning a car, which is far greater than the actual vehicle cost. This is why it's vital to truly understand the financial commitments and make a budget before purchasing a car. When you purchase a car, you have two options: pay for the car with cash or apply for a loan. If your expenses are low and it's possible to save enough money to buy a car with cash, this is a great option. Owning a car already comes with other monthly costs, such as gas and car insurance, which we'll talk about later. If you don't have to pay a monthly payment for a loan, you'll have more money each month for savings and other expenses. You also won't pay any interest to a lender. But there can be challenges as well. For one thing, you'll need to be patient, be disciplined about following a monthly budget and building a savings. Also, if you purchase a cheap car with cash, you may end up with higher maintenance costs if the car breaks down frequently. When you take out a loan, you can give the money you saved for a car to the lender as a down payment, which reduces the amount of debt you need. The loan will cover the rest of the price of the car, and paying each month will build your credit. However, there are downsides to taking out a loan. When you owe money to a lender, the lender is technically the owner of the car until you finish paying off the loan. This means that if you don't pay your monthly payment, the lender can repossess your car and resell it. And if they sell it for less than you owe on your car loan, then you still owe the lender money. The other downside is that if you pay interest to the lender, that doesn't reduce the amount of debt you owe. The total interest can be thousands of dollars by the time you finish paying the loan. Feel free to use this link at the bottom of the slide and also paste it in the video description, which can calculate how much you can save by paying cash versus taking out a loan. When you are thinking about getting a loan, you also need to shop around for the best deal. It is a good idea to compare loan options from at least 3 different lenders so you can get a sense of what the best deal is for you. Be careful if you are thinking about getting a loan. A salesperson will usually try to see how much you are willing to pay on your monthly payment so that they can sell you as expensive of a car as possible. It is really important that when this happens, you think about what your budget is that you decided on before you go shopping. The car dealer wants to make as much money as possible from selling you a car. It is your responsibility to protect your money and your financial goals. It's usually best to get pre-approved for a loan from a credit union or a bank before going to the dealership to shop for a car. This way, you already know your interest rate and the highest price you can buy. If you get pre-approved for a loan for a used car, the lender may have other requirements, such as a franchise dealership, a maximum age, and a maximum mileage. The dealer will probably try to convince you to finance with them, and they may offer a lower interest rate. You can tell them you are not interested, or you can fill out their credit application and see what they offer. If they offer a lower interest rate, great, but be very careful when you read your contract, since they might try to get this money back with fees or an extended warranty, which we will cover in the next section. What's worth noting is that dealerships usually have the highest interest rates, and credit unions generally have the lowest interest rates, and may be more willing to work with you if you have bad credit. Banks offer similar rates as credit unions, but because they are national or multinational, their criteria for qualifying can be more rigid. A financial coach can help you look at all of the options and what might be best for your individual financial situation. So why would the dealership want to finance you? To get the most profit out of the deal. Here are several things to be aware of when considering being financed by a dealership. Beware of packed payments, meaning the dealership is intentionally overstating the monthly payment quoted to a customer. Typically, when packing payments, the dealership gets the customer to agree to the purchase of the vehicle at an inflated payment by incorporating additional financial items, such as an extended warranty, gap insurance, or other supplementary products, into your auto loan without disclosing them to you at the time of signing the contract. Alternatively, the dealer may tell you the lender will not approve your loan unless you purchase an extended warranty and/or gap insurance, or some other back-end product the dealer is selling. An extended warranty is an optional vehicle service contract offered by manufacturers, dealerships, and independent providers at an extra cost beyond the purchase price to cover the price to repair or replace certain parts for a specified period. Gap insurance is an optional car insurance coverage that helps pay off your auto loan if your car is totaled or stolen and you owe more than the car's depreciated value. Notice that both of these items are optional. You should never feel forced into adding this to your loan payment. Dealers will also shop your application to several lenders, then can mark up the interest rate by up to 2.5% for 60-month loans or less, which goes to them instead of the lender. Dealers are under no obligation to select the lowest interest rate option you qualify for, or even tell you your credit score. When you sign the contract for an auto loan, it doesn't mean you are stuck with that lender for all of the years of the loan. You can refinance with a different lender. Why do people refinance? They do it to save money, either by paying a lower monthly payment or by saving money in total interest paid to the lender. Here's an example. If your credit score goes up or the interest rate in the market goes down, you can refinance your auto loan to get a lower interest rate, which saves you money in the long run. When you refinance, you can also change the term of your auto loan, the number of years. If you want to get out of debt sooner, you can refinance a shorter time period. If you want to get out of debt sooner, you can refinance to a shorter time period. Even though your monthly payment will be higher, you will finish paying your debt sooner, and you'll pay much less in total interest. Another example is if your monthly payment is too expensive and you want to lower it, you can refinance for a longer period of time. The disadvantage here is that you will be in debt for longer and pay more interest. If you want to refinance, first look into the details about your current loan, including monthly payment, remaining balance, loan term, and interest rate, which can usually all be found in the loan contract. Then check your credit score. After that, you can visit your local credit union or bank to ask about and apply for a new loan. Be sure to compare the new loan offers with your current loan, and then select one that fits your needs. It's important to understand how loan payments work. In the beginning, you pay more money for interest with every payment you make. That's because interest grows during the month. And the higher your balance is, the more interest grows before your next payment. As the months and years go by, more of your payment will go toward the principal, the debt you owe, and less towards interest. This is important to remember if you want to refinance. If you're trying to save money by refinancing to a lower interest rate, you should try to get your credit score up quickly so you can qualify for a better loan and refinance sooner. The sooner you do this, the more money you save in interest, since interest is a bigger part of every payment at the start of the loan. Different cars will cost more or less to own. It is important to think about how much it will cost to drive, repair, and maintain the vehicle. The biggest cost is fuel and fuel efficiency, a topic we covered in part 1 of this video series on selecting and purchasing a car. Maintenance is important as well. You need to pay for oil changes to keep your car in working condition. This is every 3,000 to 5,000 miles, which could be multiple times a year depending on how far you commute to work. You will also need to pay for repairs to your car. Some brands of cars are reliable, while other brands are known for needing frequent repairs. When your car breaks down, it's usually unexpected, so it's important to have emergency savings to pay for these costs. Insurance is the second biggest cost after fuel. Insurance is often more expensive for more expensive cars, but there are lots of other factors that affect insurance, such as your age, how long you've had your license, how many miles you plan to drive each year, what neighborhood you live in, and if you've received any drinking tickets in the past. You are required by law to have car insurance, though some types of insurance are optional. Depreciation means how well your car holds its value. This is very important. If you buy a brand new car, it depreciates quickly, so you can't resell it for the same amount as you purchased it for. After a year or two, it starts to lose less of its value each year, which means you could sell it closer to the price you paid for it. So if possible, you want to buy a slightly used car that is still in good shape. Thank you for watching part 2 on the car buying video series on how to budget for purchasing a car. We hope you will join us for part 3 of the video series, Understanding Car Insurance and Warranty. To receive additional support in your car purchase, please get in touch with your local IRC office to connect with a financial coach for free one-on-one coaching. If you would like to access financial coaching in Dari or Pashto, please email safeproject@rescue.org to connect with a financial coach.